Sometimes I got a real bad habit of saying, okay, I'm done my third video. And then I check like Zero Hedge, check some of my sites I like to read. Oh, there's a new article. Oh, that's a good one. Yeah, I want to do that one. And then I got to come right back and just do another video just because. I always talk about, the Federal Reserve and when we look at inflation and the unemployment numbers and we need more inflation, I'm like, wait a minute. You don't even check the things that any moron would even check to determine if we got inflation or not. You check nonsense. What's the price of a stack of printer paper today? Okay, good. Yeah, good. Put that in the matrix. That's what we'll go with in 2017 to see if inflation's hitting or not. Cost of a stack of paper for printers. How about food, energy? No? Okay. I always say that, right? So this fits right in with that. Zero Hedge. The Fed's definition of price stability is probably different than yours. Authored by Michael Lebowitz via 720global.com for Zero Hedge. The Federal Reserve Act, as mandated by Congress, established a dual mandate to guide the Federal Reserve, or Fed, in setting monetary policy. Price stability, one of the mandates, benefits economic growth as it allows investors, corporations, and consumers the ability to better predict future prices and therefore allocate investments and spending in a more optimal manner. To consider why price stability is beneficial, consider an oil producer deciding whether or not to invest in a new well. To simplify the analysis, assume the producer only needs to consider 3 variables to properly evaluate the project. A, investment cost, a fixed variable. B, a reliable estimation of the amount of oil. And C, the future price of oil. The expected return equation dictates that profits must be greater than costs. B plus C must be greater than A. To forecast a profit on the investment. The company has some control over investment costs and the surveying methods to determine the success of the well, but they have little, if any, control over the future price of oil. Therefore, the more stable and predictable the future price of oil, the more comfort the producer can have in making its decision about a new well. As laid out in the above scenario, the Fed's price stability objective appears to be positive for the oil executives tasked to make the investment decision. At first glance, who can argue that price stability is a bad thing? The problem, though, is not the objective itself, but how the Fed defines price stability. Currently, the Fed believes that their objective to maintain price stability would be met if prices, as measured by the Core Personal Consumption Expenditure Deflator, PCE, Fed's preferred inflation gauge, were to increase at a 2% rate per year. Ask your spouse, family member, or friend what price stability means, and they will likely describe a relatively constant price for goods and services over time. Corporate executives and investors would likely answer similarly. It is this juxtaposition between the Fed's definition of stability and the definition most people would use that is worth exploring. More specifically, how has the Fed sold us on the idea that inflation and stability are the same things? The example charts 2 series of annual rates of price change to help answer the question. And I'm going to put that on for you. Which is more stable, the blue or the green line? We venture to guess that you think the blue line is more stable. The problem with that judgment is that it does not factor in price stability over any time horizon. To maximize profits or quality of consumption, investors, corporations, and consumers are better served with predictability around what the effect of price changes will be over the long term. Given the long time frames associated with investments, capital expenditures, and higher price consumption, annual or even monthly variations in the rate of inflation hold little value. Longer-term trends and the value of the dollar are what matter most. The graph below, using the same data as the graph above, charts the purchasing power of $100 over the 20-year period. Now let's look at that blue line. Flat rate, and then random is the green line. At a stable 2% rate of inflation, the blue line, the purchasing power of the dollar will be cut in half in 20 years. Said differently, the car you like, priced at $35,000 today, will cost you $70,000 under a stable price regime in 20 years. Speaking of which, I've talked about this because I've showed you the data. In 2008, a standard pickup truck would cost around $28,000. In 2017 and 16, that same pickup truck is now closer to $48,000 to $50,000. That's not 20 years. We're only 10 years. And not even actually, 2008 to 18 is 10 years. We're not technically 10 years. And we've already seen that. So my goodness. Conversely, under the random scenario, the green line or whatever, with unpredictable year-to-year price changes, the purchasing power of the dollar remains largely intact for the entire period. That's the random one. We now ask again, which scenario is more stable? Which scenario would likely provide more value to our oil executives or anyone needing to know what a dollar can buy in the future? Case closed. So anyway, I just want to share that with you. This is what I always talk about when I bring up this same thing about, number one, the thing with the car, $28,000 for the truck, now it's $50,000, and simply the fact that the Fed doesn't look at anything you and I would normally look at to figure out where we're heading, what price point should be in the future, where they're going to be. No, we're just going to focus on 2% inflation with nonsensical data that is meaningless practically, and we're not looking out into the future. It's just today only. Oh yeah, so we look out in the future a little bit, and it's, oh my gosh, that's actually really bad. Wow. Quick, look surprised. We got the, I mean, come on. We do have the greatest politicians in the world that money can buy. What would you expect? Take care.